leases. I'm going to say, well, what is the change? Who does it apply to? What's the status quo? What are we currently doing? But then under the new standard, how is it different? How does the definition of a lease change? A few exceptions, and then hopefully finish off with a little bit of some examples to make it make sense rather than just the theory of leases. So to put it into context, at the moment, leases, you might know they're split between finance and operating. So you've got operating leases that are not on your balance sheet, finance leases that are. Most people have sort of heard of that distinction, but the problem that was occurring is we were getting situations where companies were going bankrupt and there were large contractual liabilities that had never been disclosed on their balance sheet. So for instance, when Borders, the bookstore in the US, went bankrupt, the liabilities they had in terms of lease commitments was 7 times higher than the liabilities they actually were showing on their balance sheet. So the International Accounting Standards Board had a look at that and said, well, maybe our accounts aren't really giving a true picture of the liabilities that organisations have. So how can we change the way we account for leases so that even where it is an operating lease, we actually show something on the balance sheet so people looking at your accounts get a truer understanding of the liabilities that are there in place in relation to your organisation. So that's the context of where this has come from. The timeline of it, so back in February 2016, this new standard was issued. I think a lot of people looked at it and said, it's come out in 2016, it's not applicable until 2019, I don't need to worry about this, I'll put it off till later. We now get to 2019 and people are saying, I haven't got enough time to implement this. Why didn't anyone tell me about it? Can't we do it a bit later? But it's been there for the last 3 years. So the excuse of, I didn't know about it, I'm not prepared for it, isn't really going to work any longer. You also need to look at which financial year will the changes be applicable to. So they're applicable from the financial year that begins on or after 1 January 2019. So for most organisations with a 30 June year end, this new leases standard you'll have to apply in your 1920 year. So you've got another week to get ready and then 1 July 2019, it's applicable. If you're a December year end, it's a little bit earlier. You should already be accounting for leases under this new standard because it was applicable from 1 January 19. If you're not quite across it, you've still got until the end of the year to make sure you're across it, get your journal entries updated, maybe make a few year-end adjustments. So who does it apply to? There's a lot of people who try and say, well, I do special purpose reporting. I can do what I want, right? I don't have to follow accounting standards. But what we're actually seeing is that increasingly organisations are being required to apply all of the accounting standards. So for those of you that deal with ORIC registered corporations, you already had to do general purpose reporting, you already had to apply all the accounting standards, no change there. But for those that are incorporated associations, we had the new Act back in 2015 that then said you have to apply all the accounting standards. And for anyone that's dealing with for-profit companies, we've got greater clarification from ASIC in terms of the application of RG85, which again is saying ASIC registered corporations, once you're large proprietary, once you're lodging financials with ASIC, yes, you should be applying all of the accounting standards. So in a sense, you need to look at this and say, this is the new normal, the new way that everyone will start accounting for leases. So in a sense, you've got no choice. You have to get your head around it and start implementing it. There'll be some organisations where you'll need to implement, I guess in terms of the new standard, it's composed of disclosures and recognition measurement. For those who've got your food, you start eating before it gets cold. Recognition and measurement and disclosures. So when you prepare your financial statements, the disclosures part of it is what information do you need to tell people, what words do you need to have in your financial report. The recognition and measurement part is how do you calculate the numbers. So if you're doing special purpose reporting, you might be able to avoid some of the disclosures that come in this standard, but you're still going to have to comply with the recognition and measurement component, which is how do you calculate the numbers in your accounts. The other point to highlight in terms of the new standard is for lessor accounting, so where you own the asset and you're renting it out to someone, there's essentially no change. You keep doing what you're already doing. For lessee accounting, where someone else owns the asset and you're renting it from them, that's where the significant change is. Essentially what you'll end up seeing is that something that was a finance lease before pretty much doesn't change. For almost everything that was a operating lease before, that's where you're going to see the change, because you'll have more assets on your balance sheet, more liabilities on your balance sheet, but also on your profit and loss statement, you'll see a change that where you used to have an operating expense of rent expense, instead you'll now start seeing interest expense and amortisation expense. So that has the potential to create some confusion with the people who are reading your accounts, even whether that's board members at board meetings looking at your management accounts or your members at the AGM reading the financials. When people understand this idea of rent expense, to see, well, we're renting it, but we're reporting interest expense and depreciation expense, that could create a bit of confusion. So that's something to understand there. You'll also see it. So,
Alistair, sorry, what's the difference between an operational lease and a financial lease?
What is the difference? Good question.
Yeah.
Operating lease, financing lease. So under the old standard, you had this you had to decide who had the rights and responsibilities in relation to an asset. So if you were renting something, so let's say maybe you were renting a server. So some people, a computer server, maybe the server's only going to work for 3 years and then it pretty much dies. So if you're renting it for 3 years, you've got it for most of the life of the asset. If it breaks, you're responsible for fixing it. In a sense, you have the responsibilities like an owner of that asset. And so those were the ones that would tend to be a financing lease, where it would show on your balance sheet as your asset. And if you had a 3-year contract, the payments you had to make for the whole 3 years would be on your liabilities. So that was a finance lease. An operating lease was something like renting an office space or renting a property, where you're renting it for much less than the whole life of the asset. If there's damage, if it breaks, it's the owner's responsibility. And so that's what would be seen as an operating lease, where as you make each payment, it just goes as an expense on your profit and loss. There's nothing on your balance sheet. Hopefully that makes sense too.
Yeah, no, that's fine.
So that was the distinction we had under the old standard.
Yeah.
Under the new standard, it's saying we don't have that distinction anymore. Almost everything, if you're renting it, if you've got access to the use of it, then it'll be on your balance sheet as an asset. So, which is a great lead into status quo. What are we currently doing? Operating leases, as I've said, are not on your balance sheet. Rent expense just goes through your P&L. So I'm going to take you through an example with some numbers to try and show you the impact of what will this actually look like, how will it change. So I'm using the example of renting an office. So a lot of people rent property. We've got an example where you're paying $72,000 per year and you've got a 3-year rental contract. Now, the other important thing to note is we've said, what is the incremental borrowing rate? Now, that's something that has to be there as part of the calculation. I'm not going to go into the detail of how you actually calculate the numbers and how that fits in. That gets a bit too technical for at breakfast. But the point to note, and for people in organisations, is how do you know what that interest rate is? In almost every situation, it's going to be your incremental borrowing rate, which means as you're doing the accounting for it, for the bookkeepers, the CEOs, the people who are working in the organisations, you're going to need to make an assessment of, if I went out to borrow money from the bank in order to buy this asset, what interest rate would the bank charge me to borrow to buy this asset? because that is the interest rate that's going to need to be used in the calculation. So when your auditor comes to look at your accounts, when your accountant goes to do the calculations for you, they're going to be saying to you, what is your incremental borrowing rate? So that's where, before you get to the end of the year, you're going to need to have assessed, if we were to borrow money, what interest rate would the bank charge us?
How do you demonstrate that to your auditors, given that if you were to go out and obviously ask that question,
Yeah.
everybody's got different borrowing rates, so
Yeah.
would there have to be something that we say, well, I approach these people and this is how I ascertain that, or?
It can be. So the question is, how do you demonstrate what that rate should be? And it may be that you've recently applied for a bank loan and you've got a letter of offer from the bank. It could be that you are renting some assets, but you've borrowed money to buy other assets, so you can show, well, this is what the bank has actually offered us. If you can't go with either of those, it may be that you've got sister organisations or other organisations you work closely with who've borrowed money. And beyond that, you're then going to be saying, well, we can go to the Reserve Bank website where they've got a list of the interest rates that are offered for various types of loans of various lengths and various amounts of risk. And then you can say, well, this is the one that most closely fits, but we're going to add a little bit or take a little bit because of our specific factors. So there's a number of ways depending on the circumstances. So hopefully that gives you some insight. So what do the numbers actually look like? So here what I've done is across the 3 years, we've compared, so this one we're looking at your profit and loss statement, comparing the old and the new. So hopefully it's not too small that you can almost read it. So we've got year 1 over here, and we're saying under the current standard, you'd show an expense of $72,000, and that was all you had on your profit and loss. Under the new standard, once you implement this, what you'll then see is there is no rent expense on your profit and loss anymore, but instead you'll have $14,000 of interest expense, $61,000 of depreciation expense, or more technically amortisation. That's going to create confusion. I'm going to skip over how you calculate those numbers, but there is a formula that sits behind it. What you then see is, in the current arrangement, for the second and third years, you'd have that same expense each year. Under the new arrangement, the depreciation part, because it's straight line, you get that same $61,000 in your expenses each year for the 3 years. But the interest component is higher at the start, and the third year it comes down to $4,000 rather than $14,000. So you get this change happening where just by implementing the new standard, the timing of your expenses, you're getting higher expenses at the start and lower expenses toward the end. We then say, well, what happens on your balance sheet? Under the old standard, you're renting an office space, so nothing on your balance sheet. Under the new standard, you're going to have a right of use asset, which is a non-current asset. It sits on your balance sheet with your property, plant and equipment. In the first year, $120,000, then $60,000, then nothing. But you're going to have liabilities that are split between current and non-current. So you have $60,000 of current, $79,000 non-current, then $79,000 non-current, then nothing. What you might be seeing with that is that it'll actually change your ratios. So for some organisations, they might be reporting to the board what's the current ratio with comparison to your current assets and your current liabilities. Now, just by implementing the new standard, it's going to change what that ratio is in your situation. You might have borrowed money and there might be bank covenants you've got where the bank says you have to make sure your current ratio stays above a certain level. And if it goes below that, we're either going to increase your interest rate or we're going to call back for the money to be repaid. So this is where if you have a lot of rentals, you're going to want to, before you get to the end of the year, have calculated the impact of the standard and then actually be talking to your bank to say, well, this is the change that's going to happen, and making sure your bank manager is across that, because you don't want to get to a year's time, provide your set of financials to the bank, and they say, oh, but your ratio's changed. Well, you need to repay the whole money or we're going to increase the interest rate, whatever it might be. And then you've got your cash flow statement. So for most organisations, if you're preparing annual financial statements, you'll have the cash flow statement in there as well. Now that's also going to change. The actual dollar amount of the cash, you see at the bottom here, it's still under the old or the new, it's still $72,000 you're paying out each year. Under the old, it's sat in your operating cash flows as a $72,000 cash outflow. Under the new standard, the interest part, or interest expense, you've always had the choice between financing or operating, so you can choose there, but the principal component comes into the financing section on your statement of cash flows. So again, it will change the presentation, and by having a cash outflow sitting as financing, your operating cash flows will actually look better than they would have under the old standard. So, quick introduction, that gives you an idea of what impact it's going to have, why it's so significant, and why I've taken time out of your morning to try and tell you about this. What is a lease? There's a slight change in the definition of it, which I'll just touch on only very briefly, is that under the old standard, it was an agreement where the lessor conveyed to the lessee, in return for payment, the right to use an asset over a period of time. Under the new standard, they now say it's a contract or part of a contract that conveys the right to control the use of an identified asset in exchange for consideration. Now, the parts that become important here is control the use of and the identified asset. So when you're looking at rental contracts, there'll be some where you might initially look at it and think it's a lease, but then when you talk to your accountant, they'll say, well, no, it's not an identified asset. So something like if you're renting an office space, the contract says it's number 10 on that street. The lessor can't say, well, today I'm going to put you at number 12, tomorrow you'll be at number 10, and then tomorrow we're going to have you in the next suburb. So you're renting an identified asset because you know which house you're renting. But maybe if you were renting a piece of construction equipment, the lessor might be allowed to say, well, today I'm going to give you serial number 10 and tomorrow we'll give you serial number 12, and they can change the asset that you've got. So then you won't have an identified asset because the lessor can switch and change which item they're giving you. So then that won't be a lease. So everything I'm talking about won't apply. The same with control the use of, and so there's some information in the standard as to how that's defined, which ask me later if you want more details on that. So what things are we talking about? We're talking about rentals of land, rentals of building, property, vehicles, machinery, large IT equipment, photocopiers and so on. There's also the possibility that you could have a single contract that is partly a lease and partly something else. So a good example is your phone contract, where you might be paying $80 a month and you get the use of a phone handset and also a SIM card to allow you to make calls, but you're making one payment. So things like that, you need to be able to identify, well, we are getting the use of an asset, and then go and talk to your accountant to say, how do I split up of that payment, which part is the lease cost and which part is the phone rental cost? So they give us this helpful diagram to be able to split it out. What is a lease? You need the identified asset, you need to get the economic benefits of the use of the asset, and you have to be able to direct the use of it. If you meet all three of those, you've got a lease contract and you account for it. Yeah.
If it's an unidentified asset, it's not identified, it just goes straight to the balance sheet. Like
Correct.
The P&L.
Correct. So if it's an asset that is not specifically identified, the accounting treatment for it is the same as what we currently do, which is just expense on the P&L, nothing on the balance sheet.
You're going to apply this new thing of hot desking that's coming up, where you just pay almost a membership fee or something, and you just go and use ADES wherever you want, whenever you like.
Yeah, so hot desking is a good example of something that will not be covered by this standard, because you're paying for the use of a desk, but it's not specific of which desk will you be using. You're just saying, I need to be given access to a desk, a chair, a table, but you might be in desk 1 today, desk 2 tomorrow, desk 10 the next day. thankfully there's a couple of exceptions or a couple of get-out clauses where you don't have to apply this painfully difficult standard. They're split into two categories. So one is your short-term leases. So anything where it's less than 12 months. So if you're renting a motor vehicle, maybe you travel down to Perth and you hire a car for the week that you're there and then you come back. It's less than 12 months. It's not a lease. You just account for it as you currently do. But when they wrote the standard, they said, now what people are going to do is they're going to say, I want to rent that property for 10 years, so I'm going to get a 12-month lease, or an 11-month lease, and every 11 months, I'll just renew it for another 11 months. So the standard writer said, well, we know people are going to try and do that, so we'll actually put it in there and say, if it's reasonably certain that you're going to renew your lease, you have to include the option periods in the time period you're looking at. So you can't say, I've got an 11-month lease for this property, and written in the contract there's 10 options to renew for 11 months each time. You look at it and say, well, looking at all of the factors of our organisation, it is reasonably certain we're going to renew it beyond 12 months, and so therefore you would still have to take all of those option periods in to calculate the accounting for it. The other exception that they've put in is they've said for low value assets. Now this is, they talk about the cost of the asset as new. So if you're renting a second-hand asset, you have to look what was the value of it when it was new. Now, I know it says $5,000 on the screen. That there is as a guide, but they have not put a bright line in the standard. So they haven't got this, if it's $4,999, it's low value, and $5,001, it's not low value. We don't have that. But what they have in the guidance done is they've said a rental of a motor vehicle will not be low value. A rental of a computer will be low value. So you've sort of got that idea of something that's about $1,000, $1,500 to buy is definitely low value. Something that's $10,000 or more to buy is definitely not low value. Things that sit in the middle, you've got a little bit of judgment room, a little bit of wiggle room to argue either way. But as a rough guide, you're looking about the $5,000 mark as the cut-off for things that are low value.
What about if you got 200 computers?
Yep.
So the liability is quite big, but individually it's not.
Yeah, so there will be situations where you rent a large number of low value assets, so the example being 200 computers. And the standard says that you look at each asset individually. So you can choose to, even though you've got 200 computers and the dollar amounts will be quite large, you can still choose to account for it in the current way, but you do have the option to account for it under the new standard if you wanted to as a group of assets. So some flexibility where you've got leases of lots of different assets. What do the accounting entries look like? I'll just run through this quite quickly. When you initially recognise the asset, you do the calculation, you calculate the value of the liabilities that you're going to pay. That whole amount comes to your balance sheet as a liability, and the same amount goes to your assets as the right to use asset. There's some detail there in terms of how you calculate that, which come back to me if you want more clarification. But in the interest of time, I'll skip over that. You also have to work out which payments you include or exclude. So when you're looking at your contracts, identify what type of payments are there. Talk to your accountant about how to account for it. Anything that is a fixed payment or payments that you are reasonably certain you're going to have to make do get included in the calculation. Things that are variable don't get included. So if you've got a rental of retail space and you have to pay the lessor a percentage of your sales, that will not be included in the calculation because you don't know what the percentage is going to be. But if you've got a contract that says, as long as the asset is available for use and working, you have to pay us the rent. It's reasonably certain that what you're renting is going to be working, so you can't say that that's variable. Even though the contract says you might or might not, it's reasonably certain. Also, service payments. Some things you're renting might include the lessor keeping some upkeep of it. So again, that's something that you split out the service upkeep maintenance component from the rental of the asset. There's a present value component to work out in it. And as you go through year on year, you update the calculations. If there's changes in the lease, if you extend the lease, you have to update that as you go. Implementation. So when you first choose to adopt it, this is one where the boards are going to, the board of each organisation is going to need to make an accounting policy choice of how are we going to implement this, because you're given two choices. You've got full retrospective application, where you say, well, we're applying it from 1 July 2019, but we're going to go back to 1 July 2018, calculate last year how would have the numbers been different had we applied the new standard, and when we present our 2020 financial statements, we'll actually represent the 2019 accounts with changed numbers applying the new standard. So that's your full retrospective approach. A lot of work in doing it, but it gives you comparatives that are quite meaningful. They've given you the practical expedient option where you can say, well, it's too much work to do that. We're just going to start from 1 July 19, and when we do our accounts in a year's time, we'll have two columns that are calculated on two different approaches. They won't match up, but you just have to add some additional disclosures in your accounts to explain that. So that could mean a little bit more explanation at your AGM when you present your financial statements, saying, well, the accounts this year and last year are different, and here's why. Because of the new standard, that's why the expenses look higher. If you take the practical expedient option, there's another couple of practical expedients that are built in that to make your life even easier. And just take note, if you've got anything that's a sale and leaseback arrangement, which is something people have used as a way of getting off-balance sheet financing, this standard basically means it's not going to give you off-balance sheet financing any longer, so be aware of that. If you've got anything that's a sublease, so you rent it from someone and on-rent it to someone else, it gets a bit complicated, so just be aware. And peppercorn lease accounting, which was going to be very problematic for a lot of not-for-profits, we've got a temporary postponement, so you can breathe a sigh of relief for now. What they had said is, if the use of an asset that you're not paying for, so for example, a local council might allow a sporting club to use some sporting facilities at the local park, and they might pay $10 a year. The standard said you had to actually go and calculate what's the market value of what you're getting, what amount are you paying, the difference between those will be your income. And then on top of that, you look at the contract. If you've got a 99-year lease to use that sporting facilities, you look at that income for all 99 years, multiply it all through, the whole amount comes as income in the first year, but then you've got extra expenses for the next 99 years. They've said, we want to take a step back, just give a little bit clearer guidance to organisations on how to implement this. So it was to be applicable from 1 January 2019, and on the 24th of December 2018, they issued the temporary postponement, just in time. If you want to do the accounting for peppercorn lease, the option is there for early adoption, but almost everyone's saying, why would I? So, but just be aware, it is coming later. So, to finish up on leases, relax, pause. But then you need to make a plan of how are you going to implement this. The biggest takeaway I want you to take from this session is you need to go and make a list, make a schedule of all the leases that you have. Even if you forget everything I've said about how to calculate it, just go and identify what assets have we got that we don't own. Make a list of what the rentals are. Go and collate all of your rental lease contracts into a folder or somewhere where they're easily accessible. If you really want to, make a couple of columns and say, how much are we paying? What's the lease term? What's the end date? But make a schedule of all the leases you've got so that when it comes to the end of the year, you can give that to your accountant and say, here's my leases, help, what do I do? And then as you're working through the process, talk to your advisors, talk to your auditors and your accountants so that you don't end up with a surprise at the end of the year. Because what I can see is going to happen is that people will ignore this for the next 12 months, and then come the end of the year, you're going to be ready to finalise the audit, and the board of directors are going to say, my management accounts from June that we had at our board meeting are not the same as what the auditor's ready to sign off. Why are they so different? So there's that element of dealing with the expectations of board members so they know what to expect. If you really want to, the whole standard's available. You can go and read it. It's only about 60 odd pages.